Hello and welcome back to 4 Minutes. Details on the FOFA reforms package have finally been released, and this week we examine a special arrangement brokered by the FSC, and we also take a look at advisor sentiment. But first, here's your weekly news roundup. The Treasury has released its long-awaited Future of Financial Advice Information Pack, which contains key reforms the government plans to take to Parliament later this year. These include banning of all upfront and trailing commissions, including risk commissions within super, a 2-year opt-in arrangement, and the banning of all volume rebates between product or platform providers and dealer groups. However, the Financial Services Council Chief John Brogden said not all volume rebates will be banned due to an arrangement with the government brokered by the FSC. He explained to Money Management that pre-existing volume rebate arrangements will be grandfathered.
We're very pleased that the government has listened to the argument of the Financial Services Council and our members and has grandfathered all existing arrangements in place for volume rebates. This means that any volume rebate business-to-business contract in place at the date of the ban, 30 June 2012, will be grandfathered and will be able to continue to operate for the life of that contract. The other concession the government made is that volume rebates will continue to flow from fund managers down to both platforms and to superannuation funds. This is a clear indication that finally the government has understood that there are benefits to pooled funds off platforms that should be flowed back in terms of scale discounts, volume rebates to clients.
The package received a mixed response, with almost all industry bodies, including the AFA, FPA, SMSF Association SPA and ASFA, expressing concerns about the risk commissions ban within super. AMP's Craig Mellor and BT CEO Brad Cooper have also questioned this move, worrying about its impact on levels of life insurance coverage. In other news, Australian Super has partnered with 6 financial planning firms, including Godfrey Pembroke, Matrix Planning Solutions and Dixon Advisory, who will provide advice to their members. FPA Deputy Chief Dean Sanders said advisor liability remains a concern, stressing planners cannot be fully responsible for the client's loss if that loss has been initiated by product failure. Dean said this topic will be discussed during the next phase of government consultation regarding investor compensation. Macquarie has suffered a 9% profit fall over the year to 31st of March 2011, which the group mostly attributed to foreign exchange translation. UBS has replaced one of the 2 portfolio managers who left its small caps team last month, appointing Victor Gomez to the role. And finally, Japanese insurer Dai-ichi's takeover of Tower Australia has come into effect, with the ASX suspending the trading of its shares. In this week's Money Management, Caroline Munro reports on predictions that risk practices will retain value despite the commissions ban. Mike Taylor examines the impact of the commissions ban on the risk market. And in our top story, new research finds planner sentiment was heading down even before the FOFA announcement last week. For all the details on those stories and more, see tomorrow's issue of Money Management. Thank you for joining us this week. Bye for now.